What's up, you guys? Today we're going to take a look at another item on my investment checklist, and this one is known as return on capital, which is also referred to as return on invested capital. So if you see ROC or ROIC when doing your research, it's the same thing. Phil Town preaches about this in his book, Rule Number 1, and also he talks about this a lot at his seminars. And billionaire fund manager Joel Greenblatt, he also talks about this at length in his book, The Little Book That Beats the Market. This is the rate of return a business earns on investor money that they're investing, and that is stockholders or bondholders. So let's dive in a little deeper so you understand what it is, why we use it, and where we find this information.
As I just mentioned, return on capital, also known as return on invested capital, is the rate of return a business earns on investor money that they're investing, and the investors would be the stockholders or the bondholders. This is a good indication of how good the management team is at turning capital into profits. So let me show you an example. If a company uses $400,000 of capital to open up a store, which includes inventory, displays, etc., and the new store brings in $200,000 in revenue the first year, the return on capital is 50%. $200,000 in revenue divided by $400,000 in capital equals 50. If a competitor did the same thing at the same cost, but they only brought in $100,000 in revenue, the ROC is just 25%. Buying a company with a higher ROC or ROIC is better than buying a company with a lower return on capital. A higher return on capital means there's something special about the business, otherwise its competitors would have driven down the ROC to lower levels. A high return on capital is a very good indication that the company has a competitive advantage, which Warren Buffett calls a moat. If a business doesn't have any new or innovative products or services or anything that stands out from the competition, then they're going to have a lower return on capital because a competitor can come in, do the same thing, take its customers away from them, and probably do the same thing at maybe even a lower cost. So this is a great tool to compare against competitors, and our rule of thumb is we want to have a return on capital of 10% annually or better. Now let me show you where to find this information. So where I usually go, real simple, we go over to morningstar.com and let's take a look at Apple. So type in the ticker symbol here, AAPL, but Apple Inc. Wait for this to load up. And what we want to click on is key ratios. Actually, let's get there first. There we go. Now we want to click on key ratios. Here we go, key ratios. And then sometimes they have it right here, but they don't right now. They have return on assets and return on equity, but not return on capital. So we need to click on full key ratios data. That's going to open up a second page. And we want to scroll down towards the bottom. And we see return on invested capital. And in 2020, it was 30.11, trailing 12 months, 33.66. So ROC, where we see right here, ROIC, looks very good for Apple. So it's very simple to find, and we want to make sure that this is growing at 10% or better. And another thing that you can do is take a look at Apple and then compare this figure right here, or going back for a while, compare all these figures to that of their main competitors to really get an idea how good Apple's return on capital is compared to their peers.
Thanks for watching this video. Do me a favor and leave a comment below if you have any questions about this or any other topic. I'd be happy to answer any questions that you may have. And also, don't forget to hit the subscribe button below and turn on notifications so you don't miss any of our new videos. And if you'd like to learn more about the stock market but don't know where to begin, click the link below this video to schedule a call with me, and I would be happy to point you in the right direction. Thanks for watching, everyone, and I'll see you guys over in the next video. Take care.